Welcome to the SmartKeys podcast. Today we are doing a deep dive into what is, really, the most current and comprehensive guide on startup funding. It's an essential resource for anyone looking to raise capital, plan their runway, or just to get a handle on where the money is really flowing.
Exactly. We're unpacking the strategic insights from the Startup Funding Trends 2026 analysis. And this is crucial for you, whether you're a founder, maybe an investor, or just a professional who needs to understand how growth capital works today.
Right.
What's so fascinating is that the Q2 2025 data, it shows global venture activity hit a huge $91 billion. But that's not the real story.
What's the real story then?
The real story is this picture of intense concentration and selective resilience. We need to translate those massive figures, like the U.S. capturing 64% of the entire global VC pie, into actual concrete steps for your business plan.
And that's our mission for this deep dive. We're going beyond the headlines, because while that $91 billion number shows year-over-year growth, there's a quarter-over-quarter dip.
Right, which signals that things are stabilizing, maybe normalizing.
Exactly. The days of, just indiscriminate spending are completely over. This cyclical shift means diligence is deeper, and fundraising timelines are definitely stretching out. Investors are no longer valuing sheer velocity over everything else. They're demanding a sharp focus on verifiable unit economics and just plain old discipline, especially when you compare it to the frenzy we all remember from 2021.
And that demand for discipline really has to start with a reality check. It raises a critical question for every single founder out there.
Yeah.
Is institutional VC actually your path? The data is. It's just incredibly stark. Only a tiny fraction of a percent, specifically 0.05% of all startups land institutional venture capital.
Wait, 0.05%.
That's it.
That is a number that should reset expectations for almost everybody listening. Yeah. So if VC is the outcome for 5 out of every 10,000 businesses, what's holding up the rest of the ecosystem?
Well, the alternative is the real baseline. We see that somewhere between 77 and 78% of startups rely on personal savings, loans, or help from friends and family. And they often start with a median initial capital of under $25,000. So for the vast majority of businesses, the strategy has to be about bootstrapping, getting to profitability, extreme capital efficiency, not just optimizing a Series A pitch deck.
So you have to shape your entire strategy around that reality from day one.
You absolutely have to.
Okay, so let's talk about that tiny sliver of companies that do manage to attract institutional money. This is where it gets really competitive. The capital is intensely concentrated, and that basically defines who gets funded.
It really does. AI and general software solutions, for instance, drew roughly 45% of all VC dollars in Q2 2025.
Almost half.
Almost half. And this concentration isn't just, a slight trend. It's a massive realignment of capital. AI alone secured nearly $19 billion.
$19 billion.
That's about 28% of the quarter's total funding. And strategically, this investment doesn't just fund the big foundation models. It creates this huge gravitational pull, lifting up related areas like developer tools, data infrastructure, specialized cloud services.
So if you're building a tool for engineers who work at a fast-growing AI company, you're sort of riding that wave.
You are. But that concentration also creates an intense war for talent and for those very specialized tools.
Okay, but what about the sectors outside of that, that hyper-funded tech core?
Yeah.
Where's the other 55% of the money actually going?
Well, we're seeing really critical, necessary growth in what you might call defensive infrastructure. Take cybersecurity.
Okay.
Investment there rose to about $2.7 billion in Q1 2024. This isn't hype. It's pure necessity. The average cost of a data breach is now around $4.8 million per incident.
That's a huge number.
It is. And that reality is pushing C-suite budgets away from just pure growth and more toward prevention and compliance. And that's where the investment is flowing.
So on the flip side, we're seeing areas that used to ride on pure narrative now requiring very strict granular proof. Prop tech is a perfect example.
A perfect example. The average deal size in prop tech just fell off a cliff. It went from a peak of $48.9 million in 2021 all the way down to $16.8 million in 2023.
Wow, that's a massive drop.
It's a huge shift, and it represents investors just refusing to fund aspiration anymore. You can't rely on promises of market transformation.
So if I'm a founder in prop tech, what specific metrics are VCs asking for now? What's different from 2021?
You need irrefutable financial proof. Proof that your tech actually moves the needle on real estate assets. This means clear payback metrics. We're
Yep.
talking quantified net operating income, or NOI improvements, or verifiable energy and maintenance savings,
Why NOI specifically?
because it's tangible. NOI is a pre-tax measure of the income produced by the property itself. Investors want to see that your software directly impacts the asset's value and generates a return much, much faster than simple adoption metrics.
That transition is really a masterclass in how a market matures. The evaluation criteria shift from market potential to how does this affect operational cash flow?
Precisely. And if you are one of the fortunate few aiming for that institutional capital, you have to calibrate your entire ask to these hardened market expectations.
Okay, let's talk about those benchmarks. If a founder navigates that initial gauntlet and they're ready to raise, what are the median round sizes they should be aiming for?
The analysis gives us some really clear anchors here. The median Series A in the U.S. is currently sitting near $18 million.
18 million.
And if you look at more established businesses, the average Series C in 2024 was roughly $50 million. These are the numbers that have to ground your financial models, your hiring plans, everything. You just can't walk in asking for a $40 million Series A unless you have absolutely overwhelming proof to justify it.
But wait a second, isn't that 18 million median for a Series A little misleading? I mean, if these huge outlier AI companies are grabbing $100 million plus rounds, doesn't that sort of artificially inflate the median?
That's a fantastic question.
It seems like it might be masking the fact that smaller but still necessary rounds in non-AI sectors are maybe struggling.
You're right, it could be. And it suggests that while the median is 18 million, founders in, say, niche B2B or specialized hardware might need to plan for a lower figure, maybe 8 to 12 million, and focus on getting profitable much sooner. They just won't have that AI tailwind.
Right.
But that larger number also forces valuation discipline. If you take 18 million, you better be able to deploy it efficiently and justify the valuation that comes with it.
That brings us to time, the cadence. We always hear that speed is everything in startups, but this source material really emphasizes the cadence. The typical time between funding rounds is now about 2 to 3 years.
Yeah, and that 2 to 3 year cadence has to guide everything. Your hiring, your product roadmap, and your burn rate. Everything. You have to structure your milestones so they're still relevant 36 months from now.
And from a practical standpoint,
Practically, you need to plan for 12 to 18 months of runway plus a buffer. At least 6 months to account for delays during fundraising. You just can never, ever start fundraising when you only have 4 months of cash left.
and that discipline doesn't get any easier as you mature, right? Late stage funding was what, 34.7 billion in the last quarter?
It was. And that's flat quarter over quarter and way below the $46 billion peak we saw just a couple of years ago.
So what does that softness in late stage funding really mean for a founder?
It means anyone seeking those big growth rounds is facing intense scrutiny. Investors are enforcing true valuation discipline. They're moving away from valuing companies on future market share and demanding proven traction.
So things like retention rates, CAC payback.
Yeah. Exactly. High retention, rapid CAC payback periods, and maybe most importantly, strong, defensible gross margins.
Okay, so we've covered the tough realities of the market, the benchmarks. Now let's talk about the levers you can actually control to survive. We know something like 90% of startups fail. What can you actually do to increase your odds?
You have to look at why they fail. The leading operational cause is a lack of product market fit, or PMF. That accounts for 34% of failures.
34%.
Yeah. It just confirms that selling what you can build is so much less important than building what the market actually wants to buy. You have to be ruthless about validating that willingness to pay and do it early.
And what's the single biggest killer? The financial one?
It's cash flow. Cash flow problems contribute to a staggering 82% of all business failures.
82%, that's huge.
It's the ultimate operational failure. It's not just about spending too much. It's a lack of visibility, a lack of rigor in your modeling. You have to run cheap, targeted experiments to validate your product and, critically, build weekly cash flow visibility into your process.
It's so interesting that the data also points to experience as a major factor in mitigating that risk. We have this image of the 22-year-old dropout founder,
Right.
but the data tells a completely different story. The average founder is about 42 years old, and the fastest growing 0.1% of companies. They're started by people who average 45.
That is a brilliant insight. The data even suggests a 60-year-old founder often has better odds of success than a 30-year-old.
Why do you think that is?
I think it implies that success is less about raw hustle now and more about accumulated network effects, deep industry pattern recognition, and just knowing which expensive mistakes not to make.
Right, that kind of political and social capital you build over a career. Another lever you control is team structure, who you bring on the journey with you.
Absolutely. The research is clear. Teams with two founders almost always outperform solos. They raise about 30% more capital and post around 3 times the customer growth.
3 times.
3 times. Co-founders help distribute risk, they can temper overambitious plans, and they bring complementary skills that one person just can't have.
And then there's geography, where you pitch, where you operate. That plays a huge role.
A massive role. That choice concentrates talent pools and investor access. The U.S. still has the major unicorn hubs by a long shot. San Francisco leads with 256 unicorns, and New York is next with 119.
So how should a founder think about that choice?
Strategically, it has to be based on your sector. Silicon Valley is still the place for deep tech, for complex AI, for those high-risk seed networks. But New York, leans heavily into fintech, enterprise SaaS, and gives you unmatched access to financial buyers and corporate partners.
So your location directly affects who you pitch to and the comps they use to value you.
It does.
Finally, we have to talk about the persistent allocation gap for certain teams. The data shows this is a major strategic hurdle.
It really is. Female-only teams captured just 0.9% of US VC in Q2 2025.
That's less than 1%, and it's actually dropped.
It has, and you compare that to mixed-gender teams, which took almost 41% in the same quarter. This is a documented systemic bias in how capital is allocated.
So what's the actionable advice there?
Well, the generic advice of just build a better product isn't enough. The most actionable approach is to specifically target investors who focus on and track the performance of diverse teams. And more importantly, you have to build undeniable, robust revenue evidence that just overwhelms any subjective bias in the due diligence process.
So if we tie all of this together, the key takeaway for success in this new funding environment is really operational rigor and strategic patience.
And complete alignment with market realities. Use the data map we've laid out. If you're going for institutional funding, plan for that $18 million median Series A and that 2 to 3 year cadence. If your business model can't support those numbers, you have to pivot to capital efficiency and profitability like right now.
And don't just rely on one path. You should be diversifying your capital base, using angels, venture debt, grants, because the odds of landing that institutional check are just so slim. The relentless optimization of your unit economics, fast CAC payback, high gross margins, great retention, that's the only sustainable firewall you can build.
And look, given that 82% of business failures are tied directly to cash flow, your ability to model dilution across different scenarios, to run a rolling 18-month runway plan, and to do it before the clock runs out, that is so much more critical than just crafting a good story.
Right.
The quote we saw in the analysis sums it up perfectly for this new era. Use data to guide decisions, not as a post hoc justification.
Thank you for tuning in to the SmartKeys podcast. We really hope this deep dive provided the clarity you need to strategize your next steps.
And we highly encourage you to read the full article, Startup Funding Trends 2026, for even deeper context on all these benchmarks, including things we didn't get to, like regional fintech data and the precise lead-stage dynamics driving this valuation discipline.
The link to the full article can be found right there in the show notes. If this deep dive helped you strategize your next move and understand the current capital climate, please be sure to subscribe to the SmartKeys podcast wherever you listen.
We'll catch you on the next deep dive.